If this happens to you a lot, you need to watch this video. It's because you don't actually read the candlesticks properly, and you don't take advantage of the trend. Fixing this could massively improve your trading, so let's get it started from the beginning. The first thing we need to understand is that there are two types of fundamental trending movements. There is the continuation. Simply explained, continuations are movements that continue the trend that the market is currently following. So this would be a continuation trading phase. This just continues an uptrending market by following its characteristics of higher highs, higher lows, and their respective bullish breaks of structure when the market breaks up above the last highs. And then we have a reversal, which is the second type of movement. A reversal is a deviation from the previous trend. A reversal flips the previous trend into the opposite trend. The reversal from an uptrend into a downtrend is usually seen when the price stops being bullish, showing a loss of buying strength, and the price is unable to break the last swing high on the next upside movement, and then the price breaks down below the last swing low. So now we have validated a lower high and a lower low. When the market is initially on an uptrend and flips into a downtrend by breaking the last swing low. This downside break is called a bearish market structure shift. And that ends the reversal phase, and it goes again back to the continuation phase. But this time, instead of continuing an uptrend, the market continues the trend that it just created, which is a downtrend. And the continuation phase on a downtrend is seen when the market forms lower highs, lower lows, with their respective bearish breaks of structure each time the price breaks down below the last lows. So what traders want to do is buying the market as close as possible near the last swing lows during a continuation phase on an uptrend. And depending on their type of setup, they can look to take profit above the break of structure. That is, if they are looking for a scalp setup. Or they can look for a swing setup by also looking to buy as close as possible to the swing lows, but taking profit on a break of structure that is situated higher than the closest one. And on reversals, traders have two options depending on their risk parameters. They can take a higher risk and look for a sell-short setup as close as possible near the last swing highs after the market has broken down below the lows. So basically, after we got the bearish market structure shift, and looking to take profit below the bearish break of structure if they are scalpers, or below the lower breaks of structure if they are a swing trader. And we also have the approach with less risk, which is basically to look for sell-short setups as close as possible near the last swing highs. But the market has to already have formed the first bearish break of structure, and the take-profit targets are similar. The scalpers looking to target just below the upcoming break of structure, while the swing traders are looking to target a lower break of structure. Now, of course, that if we keep looking for buying setups on the continuation at some point, we are going to lose because we can't know for certain the exact moment when the market will reverse. But the longer a trend is, the more winning chances we get. For example, in this specific scenario, we would have closed 4 trades with wins and 1 trade closing as a loss. With a decent risk to reward, we are ending in profits. And the same applies for the continuation on the downtrend. We can't know for certain when the market will reverse back into an uptrend, so eventually, if we keep trading each level, we are going to lose a trade. But the same story again. If you have a decent risk to reward, and I would consider that around 1 to 2 or 1 to 3, sometimes even higher, but those setups are met more rarely. This is what I consider a decent to great risk to reward. With this risk management, you can even lose multiple trades and have a few amount of wins and still end up with profits. Now let's take a small part of this bullish structure and zoom into it. This is what we are able to see. The black lines represent the high time frame price action, and the red line represent the low time frame price action. So we got an impulsive upside move that is followed by a pullback. We now have validated a higher high and a previous higher low. Then, because the market is following an uptrend, continues the push towards the upside, which breaks up the last high. At this point now, we have validated the higher low. So having a higher high, with a higher low and the price breaking up the last high, means we've got a bullish break of structure. So this is where we would look for an entry model that sustain an uptrend bias. The simplest and most effective buying entry model is the demand zone. So if we manage to identify a demand zone near the swing lows, we would plan for future buying setups at this level. Now, after breaking into new highs, the market pulls back down again. And now is where we need to pay attention, because the pullback often ends on the demand zone. And this is where I get asked a lot, and many traders tell me that they are able and can identify these setups. But when they place their buy longs on the demand, the market instead of pushing to the upside to win their trade. Instead of that, the market breaks down the demand, stopping them out of their position. Now you need to pay very close attention, because it's normal for setups to fail, and you can't get right all the setups. What's important is to properly manage the risk of each setup so few wins will cover all the losses. But you've heard that before, so let's learn something new that I've never seen someone teach. So we can't actually know for certain if the market will respect the demand or if it will break down below it. But what we can do is we can analyze the price action, and that will help us a lot in knowing if a demand is more likely to hold. And that is done by simply just reading the candlesticks. There are a lot of candlestick patterns. However, the most important ones are only two types of candles: the continuation candle and the reversal candle, and they are very simple to read and understand, yet very few apply this simple concept. The continuation candle is simply just a candle that has a large body with small wicks. This candle signals that whatever the trend of that candle is, the more probable upcoming move is the same one as that candle. Easily explained, if a bullish continuation candle prints on the chart, there are more chances that the market will have its next candles closing bullish. And there is also the other candle, which is the reversal candle. The reversal candle has a small body and large wicks. The reversal candle signals the opposite of the continuation candle. If the trend from before was formed with bullish continuation candles and a bearish reversal candle prints, there is a high probability that the market will turn bearish, thus forming more bearish reversal candles, or more bearish continuation candles. And if the previous trend was bearish and a bullish reversal candle prints, there is a high probability that the market will turn into a trend formed with more bullish reversal candles, or more bullish continuation candles. Now all we need to do is to apply this candle theory into this type of setup. So for example, if the price approaches the demand and fills the demand, we pay close attention to the reaction. We would look to buy only after a bullish reversal candle prints. Why a bullish reversal? Because the low time frame trend was bearish, so the previous candles that are approaching the demand are bearish. And all we want to see is a bullish large candle that closes above a previous bearish candle. And even a more strong probability is when after the reversal candle, the market forms a continuation candle that supports that newly formed trend. And then we would be looking for the buy position. And if when the price fills the demand and does not react, we can still place the buy position. But because of no bullish reaction, there might be a higher probability that this demand will not hold, and the low time frame downtrend will hold for some more time, that eventually breaking down the demand. So there is a higher risk in buying a demand that does not have a bullish reaction. And now for a bearish market, where we have swing lower highs and swing lower lows, with the breaks of structure formed after the market breaks down each swing low. In bearish markets, we have supply zones that should be near the swing highs. Now again, the same candle theory applies when we see the price approaching the supply and filling the supply. If we want an increased chance that this supply will respect, we would want to see a bearish reversal candle. That bearish reversal preferably should also have a bearish continuation candle right after it. This increases the chances that this supply will respect in pushing the market down. If a bearish reversal does not form, that does not mean that it won't respect the supply. It still might respect, but it may have a lower chance of doing so, while also having a higher chance of a break above the supply, meaning that it did not respect the supply. Setup planning is all about risk management after all. So let's see on the euro-dollar. This is the 1 hour chart. What we can see on this market structure is that this certain market was following an uptrend based on its characteristics of higher highs and higher lows. Let's change the color of the lines to green to make trends easier to observe. And then after marking the local high, the market pulled back down and broke below the last low. So this is, as we said on earlier in the first minutes of the video, a market structure shift, and more specifically an internal one. Now, as expected, after a bearish market structure shift, the trend flips from an uptrend into a downtrend. The downtrend characteristics being lower lows and lower highs. Then after marking a local low, the price started to pull back up, which is not a problem because that's what it's supposed to happen, entering into a pullback phase soon after breaking the lows. All of that in order to get more orders and liquidity to potentially break into new lows. Now here is when we got again the local high from where the market pushed back down, breaking its last lows, and basically we've got the same price action as we've seen before. So a market structure shift internally. The high time frame was following a downtrend, But the internal low time frame was following an uptrend because the pullback in a downtrend is a low time frame uptrend. And when the last breaks internally, the market shifts internally from an uptrend into a downtrend. So basically, it flips the internal trend and aligns it with the high time frame external trend. Now after a shift, we would expect this kind of price action to form here. So a formation of lower highs and lower lows, this to move towards the external lows in order to continue the external downtrend. So knowing that the shift has printed and the external trend is bearish, we can look at the recent price movements and look for a bearish entry structure. On Forex, one of the most effective bearish entry models are supply zones. The supply zone is the last upside candle before a downside impulse or before the downside movement started to form. And that should be near these price levels, and if we look more clearly, this should be the candle that forms the supply, being the last up candle before the downside started to happen. The setup planning on supply zones is basically just selling on the bottom of the supply, with the stop loss above the supply, and take profit below recent swing lows, or even below the external swing lows. But in that case, because the risk reward is too high, I would take multiple partial profits, so like here 20%, then at the next level 20% more, and 20% more, and so on. But here to keep it simple, we are going to target only the most recent lows. It still has a decent risk reward. Now here, there is a candle that filled the order with a wick and closed the order on the take profit on the same candle. On this backtest, if we were to analyze candles to base the entry, we would have missed the trade. On the 15-minute time frame, it's still one candle. Let's go even lower. And on the 1-minute chart, this was one candle that filled the order as well. Well, this looks like an insane manipulation. For the traders that say that supply and demand is a bad strategy, explain how the price pushed right into the supply and rejected back down instantly on one candle like that. Now be mindful, this happens pretty rare, but it's still crazy. On the S&P 500, we're looking again at the 1-hour chart. I like the 1-hour time frame the most because it has a great mix of being not too high of a time frame, but also not too low. It's sort of a great balance and gives fair chances to both scalping setup and swing setups. So anyway, starting with market structure analysis. From the first look, this looks to be a downtrend, but we should closely analyze to make sure we don't get trapped. It's always worth it to put in the extra work and patience to avoid a loss rather than forcing a trade and hoping for a positive results. So the market had low volume with small-sized candles at the beginning, and soon after the price started to push downwards aggressively, with the volume kicking in and especially in the favor of sellers. Now what do we have after a continuation phase? If you looked at my videos, you should know by now that after a continuation phase comes a pullback, and a pullback on a downtrend is a low time frame uptrend. Now this low time frame uptrend formed a local high from where the pullback ended, and we came back into a continuation phase with selling volume coming back into the market. Now this market structure is actually very simple to see, especially the swing points. So we mark the swing highs. And then what came after was a lower low, then the pullback that ended and formed a high, but a high lower than the last one, so basically a lower high. And the last continuation phase that we talked about formed a lower low, and of course if the price breaks down below the lows in a downtrend, we get a bearish break of structure on the swing level. And now a very similar price action is happening again, so after the continuation phase ended from that break of structure, we entered again into a pullback phase. And again, as I said before, and this is very important, that a pullback in a high time frame or external downtrend is a low time frame uptrend. What we would expect is for the market to continue slightly higher, but it should end below the last swing highs. So we expect a lower high, then entering again into a continuation phase that breaks down below the lows to form in a break of structure. Again, the logic being that we are looking to trade with the trend. Now we don't actually know where the high will end up. It's impossible to predict that. And also, it's not sure that it will form another lower high. The market could also break above and reverse into an uptrend. We are just trading with a probability mindset. What are the chances that after hours or days of downtrend, when I come into the charts and place a position, what are the chances that at that exact moment the market would reverse? Chances are pretty low, and sometimes it happens. However, based on probability alone, it shouldn't happen most of the times. So zooming into the last price action to see it more clear, I will also mark the internal levels to make sure everyone understands. The low time frame uptrend, which is a high time frame downtrend, has internal higher highs with internal higher lows. Now we have two options. Now we can also trade the pullback as long as we're looking to take profit below the last higher lows. Let's show how this would work on a simple presentation. So we've got a downtrend, as I said probably 3 or 4 times already in this video. In a pullback phase during a downtrend, we have a low time frame uptrend. So what also we can do is we can look for buy setups on this low time frame uptrend. But we won't be looking to target above the swing highs because that would mean that we expect a trend reversal, and we have no sign of a reversal. We also can't know where the top of the high will be, so in this case I would target with the most simplistic plan, basically just looking for a 1 to 2 risk reward, and now coming back into the charts, we look at the most recent price, and we ask ourselves, what caused this move? And to answer that, we look for an entry structure. Now because this internal price action is in an uptrend, on uptrends we look for demand zones. The demand zone is the last down candle before the start of the upside impulse. And here it's pretty easy to observe, this being the candle that formed the demand zone, and if we pay attention, the market formed the high and pulled back down exactly to the demand. And look at the candle pattern when it has hit the demand. A very bullish candle that reacts after hitting the demand. And the next candles are also very bullish. So if we implement the demand theory with the theory of candle patterns, let's say that we've seen this later on this last candle, so we are late in the position. But because of the confirmation of very bullish continuation candles, we can now place the stop loss right below the first bullish candle and the take profit above the internal highs to basically form new internal breaks of structure. But be careful, I'm not saying above the last swing highs, because on the swing highs we do not expect a higher high. And this was a very simple and straightforward setup. After those first 3 bullish candles formed, literally every single candle closed bullish, with no sign of reversal on the internal structure. Now what's interesting is that we can use these candle patterns and implement it with support and resistance and supply and demand. Let's see how. So we choose one high time frame. In this time frame, all we need to do is just to analyze the demand zone. If the market is bullish, then when the price is approaching the demand, we zoom into a lower time frame. Normally we would buy the demand, but what we can also do is to implement support and resistance. So if we got the price forming in a consolidation, basically having the market moving sideways on the lower time frame, then mark out the support and resistance areas. And because the market was following an uptrend and has hit the demand, the higher probability is that it will break out to the upside. In that case, we can buy long directly, but only if it closes above with a continuation bullish candle, with the stop loss below the last low from the support, and take profit at around 1 to 2, or 1 to 3, or even above the swing highs depending on the market conditions. There is also the case where the market would break down the support, and in that case, it also has a high chance of breaking down the demand, and that would invalidate this demand. And on a bearish market, it's the opposite way around. We look for supply zones on the high time frame. Then we switch into a lower time frame when the price approaches the supply. If on the hit of the supply the price forms a consolidation, we mark the support and resistance levels. Because the market was following a downtrend, it's more probable that it will break down the support. In that case, we can place the sell short when the market breaks down below the support. But in this case, only if it closes with a bearish continuation candle, with the stop loss above the high of the resistance, and take profit at around 1 to 2, or 1 to 3, or below the swing longs. Again, depending on market conditions, the safer approach is to wait for a retest after the breakout. But both options are valid as long as the price breaks down the support with increased selling momentum. Also, be mindful that it can also invalidate the setup, but has a lower chance of doing so. And in that case, the price would break up the resistance and invalidate the supply. Case that would probably reverse the downtrend into an uptrend, this being the negative scenario where we would lose the position. Now on the US dollar against the Japanese yen, another forex pair, I found this to be working the best on forex since it's the most liquid market. So analyzing the macro market structure, we notice a high time frame downtrend with a downwards push that forms a swing lower low, followed by an internal upside pullback. This pullback ends lower than the last high, meaning that we've got a lower high formation, followed by an internal downtrend that aligns with the high time frame downtrend to basically form another lower low Nothing exceptionally hard, just a simple high time frame downtrend so far. On downtrends, we've got bearish breaks of structure, below each time the market breaks down below past swing lows. And now on the recent price movements, we can see that it's basically looks to be repeating a similar price action. So again, another upside pullback, with a high that ends up lower than the last high, so having a lower high formation on the swing level, and the last price that we see is a consolidation on this level. We can also see that lows are higher than last ones. So does that mean that we've got higher lows? Not really, because except the swing one, the rest of the lows are internal lows that represent the lower time frame pullback. So there is no significant sign that this market could reverse into an uptrend. So why would I look to buy a market that is constantly going lower and lower? What are the chances that exactly when I buy the market will reverse into an uptrend? The chances are pretty low, so what I look to do is simply ride the trend. And the trend expectations are lower highs and lower lows, so basically a downtrend structure. So having understood that we are bearish bias, I zoom into the most recent price movements. And all that I do is to look for a bearish entry model. And on Forex, as I said, the one that I found to be performing the best is the supply zone. The supply zone is the last up candle before the downside impulse started. On this chart is very easily seen. The supply zone should be near this candle, being the last important up candle, right before it started to push to the downside pretty significantly. Now we see that this supply actually got filled in this consolidation, and actually got filled earlier with multiple wick rejections. Wick rejections from a supply are exactly what you want to see, because they are a reversal candle pattern. Upside wicks simply mean that there were buyers pushing up the price, but they did not have enough strength to push even further because sellers started to join and take control. And for the setup positioning, there are many options. We can sell short with the stop loss above the recent supply. We can sell with a stop loss above the recent highs. And the take profit is usually 1 to 2, 1 to 3, or below the last swing lows. There are many options. It depends on the type of trader you are. If you're a scalpers, the stop loss is usually tight, and you look for a smaller risk to reward with smaller targets. And if you're a swing trader, you might look for a larger take profit area and larger stop loss area. Now what we can also do here, because we see a consolidation, is to enter the trade only after a breakout. So we have the resistance up here, and we have the support down here. If the market breaks up the resistance, retest it, and flips it into a support with the price forming in a bullish internal break of structure. In this case, we cancel the sell setup plan because there might be a high probability that the supply will fail, but the chances that this will happen are pretty low. And then there is the other scenario which follows this trend, which is basically breaking down the support, retesting it, and we sell short on the retest to follow the downtrend. And looks like the second scenario is playing out. We've got the break and retest, and as I said earlier, we sell on the retest. This support and resistance implementation into the supply and demand can help the setup to have a tight stop loss with a larger take profit. The stop loss would be now right above the resistance, and the take profit can now be set below the swing external lows, essentially breaking down below the swing lows, and also breaking into below the external lows to form the break of structure on the high time frame in order to continue the downtrend. And from that point, the market went straight down. Now this is the gold chart in the 4-hour time frame. At the first look of this market structure, we easily see that it's following some kind of an uptrend, having a price action that looks more like this, forming higher highs and higher lows repeatedly. In this type of price action, we look for demand zones to plan buying setups near each of the swing lows, to basically try entering a buy at the lowest price we can. So let's look for demand zones on the chart. Here we got the first one we are able to see, and we notice how the market pulled back into the demand a couple hours later after forming it, and formed a bullish reaction, filling the demand with a wick and instantly reversing the low time frame downtrend into a low time frame uptrend, so just aligning the low time frame trend with the high time frame one. As is usual, when we have a bullish reaction on demand zones, the market targets towards higher highs. This break of previous highs is shown using a break of structure. And after a break of structure, we enter a pullback phase. Pullback that in an uptrend should end up higher than the previous pullback. So that just means that it should form higher lows. And here we also look for a demand zone, because the price action has kind of played out in a similar way. And this should be the demand. It's very simple to observe on this example. And here we also see that the demand got filled near instantly if we would zoom into the lower time frames. But the important factor is that it has respected the demand and pushed the market into trend continuation by breaking up the last swing highs. Then after it is formed in a high, the price started entering again into a pullback phase. Now we need to ask ourselves, why did the market pulled at this level, and why it looks like it is bouncing up from that certain level? So basically just looking for a demand zone. And here it's simple as well to observe the zone, being around this level. If the demand would hold, we have the continuation scenario in where the market would break up above the last highs and set in the break of structure. Now because the market is right at the demand currently, and the market looks like it has been moving sideways, we can zoom into the latest price action on the 1 hour time frame and identify the resistance and identify the support. Now we have two possible scenarios. One scenario is for the price to break down the support, retest it, and start a downtrend, basically invalidating the demand. But the scenario with the higher probability should be this one, where the market would break up the resistance, retest it, and continue towards the highs. The logic being to form a swing higher high, just like it did almost every time recently. And the scenario 2 played out. Now if we were even on a lower time frame, we could have caught a possible retest, because in here, it just broke straight above and closed above the resistance without retesting. But that's all right. So let's take the most pessimistic case where we would buy long after this candle closes. Being a very bullish continuation candle, we can place the stop loss below its lows, knowing that if the market would actually go there, it would invalidate the whole uptrend scenario. And that has pretty low probabilities. And the take profit above the last swing highs, since we are expecting to follow the break of structure, but also has to have a decently high risk to reward. And we see a small pullback and a continuation phase. Super simple setup. Now, if I were to look for what could happen next, the market can still go higher. We don't know for sure where it will stop to form the new swing high. But after that high, the market should enter a pullback phase. And if the uptrend is going to hold, it should end the pullback somewhere above the last higher lows, to then continue into new highs. This is the scenario in where the trader looking for this setup wants a trend continuation and trades with the trend. And in the case of a reversal, the market would break down below the last swing lows, forming a market structure shift. Shift from where smart traders will probably look for a lower high to sell from into a lower low. Now keep in mind that this was only about the technical side. Without the proper risk management and psychology, the technical knowledge alone does not do much. You can visit my website on the link in the description where I go in more details. Compared to others, I only have exactly what's necessary and nothing more. An A to Z, step-by-step playbook. And if you liked the video, feel free to leave a like and feedback in the comments. Thank you for watching, and see you on the next.